Investing in the financial markets requires a balanced understanding of risk, rewards, and the intricate dynamics that drive market movements. In the high-stakes world of investment, where billions can be made or lost overnight, the story of Bill Hwang and Archegos Capital Management serves as a cautionary tale. Despite the potential for high returns, the neglect of fundamental investment principles and the reliance on a handful of stocks can expose investors to catastrophic losses, as evidenced by Bill Hwang's dramatic fall from grace, losing $20 billion in just 2 days. The fallout from Hwang's implosion sent shockwaves through Wall Street, implicating major financial institutions like Goldman Sachs, Morgan Stanley, and Credit Suisse, and raising questions about the practices of hedge funds, securities fraud, and the effectiveness of regulatory oversight. In this video, we'll examine how Bill Hwang's firm Archegos managed to accumulate such vast positions, the critical role emotions like fear and greed played in Hwang's downfall, and the systemic failures that led to one of the most significant financial debacles in recent history. But first, let's understand a bit about Bill Hwang, the person. Bill Hwang's journey to financial prominence began in South Korea, where he was born and raised. Hwang moved to the United States during his youth, embodying the dream of countless immigrants seeking better opportunities. His academic pursuit in economics at UCLA, followed by an MBA from Carnegie Mellon University, laid a solid foundation for his career in finance. And Hwang's career trajectory soon took off at Hyundai Securities in New York, leading him to significant roles at Peregrine Investments Holdings and later working with Julian Robertson, the prominent American hedge fund manager at his firm Tiger Management. Whilst there, Hwang managed a substantial portion of the firm's Asian equity portfolio, a role that would set the stage for his future endeavors. With Robertson's backing, Hwang launched Tiger Asia Management with around $25 million and grew it to over $5 billion, highlighting his capability to scale investment operations significantly. Beyond his financial ventures, Hwang's personal life and philanthropic efforts reflect his values and background. As a devout Christian, influenced by his father's role as a pastor, Hwang's faith has played a pivotal role in his life decisions. Residing in New Jersey with his wife and daughter, Hwang maintained a low profile despite still being an impactful presence in his local community. His co-founding of the Grace and Mercy Foundation, with assets reportedly more than $500 million, highlights his commitment to giving back, particularly to Christian evangelical organizations and causes. Despite some setbacks, Hwang's career continued to go from strength to strength. He faced heavy losses during the 2007 to 2009 financial crisis and many legal challenges, including a ban from trading in Hong Kong for 4 years and settlements amounting to over $60 million for insider trading. However, Hwang's resilience shone through as he transitioned to establishing his own firm, Archegos Capital Management, in 2013. Archegos quickly became a significant player in financial markets. The family office was launched with initial assets under management that grew to approximately $10 billion by 2020. At the heart of Hwang's success was his willingness to embrace innovative investment strategies and take calculated risks. He demonstrated a knack for identifying opportunities in volatile markets and capitalizing on emerging trends. Hwang's unconventional approach, coupled with his deep understanding of financial markets, allowed him to consistently outperform benchmarks and deliver impressive returns for his investors. And if you want to learn how to generate significant returns in the current economic climate, don't forget to subscribe, as I'll be covering this in upcoming videos. In managing his money, Hwang utilized a combination of sophisticated financial instruments and strategies to amplify his investment capabilities. His investment philosophy was built on a foundation of risk-taking and calculated bets. He believed in an investing approach known as the Tiger way of investing, which involves deep fundamental analysis to identify a few promising stocks to invest in. Rather than adhering to traditional investment principles of diversification and risk mitigation, Huang embraced a high-risk, high-reward strategy that prioritized concentrated positions in a select few stocks. Huang employed derivatives and swaps to enhance his investment positions and capitalize on market opportunities. Derivatives are financial instruments whose value is derived from an underlying asset or group of assets. They allow investors to speculate on the future price movements of the underlying asset without owning it outright. Derivatives come in various forms, including options, futures, forwards, and swaps. By utilizing derivatives, Huang was able to gain exposure to the returns of securities without actually owning them. And by purchasing call options on stocks he believed would rise in value, Huang could amplify potential returns without committing large amounts of capital upfront. This method enabled Archegos to control large equity positions while bypassing the need for direct disclosure of their holdings, allowing him to maintain a low profile despite his substantial market influence. Among the notable positions held by Huang were shares in companies like Viacom CBS, Discovery, and prominent Chinese firms like Baidu and Tencent. Central to Huang's strategy was the use of leverage to amplify his investment positions. Leverage allows investors to control larger positions than their initial capital would otherwise permit, thereby magnifying both potential gains and losses. Huang leveraged his capital to the maximum, effectively increasing the volatility and potential returns of his portfolio. By borrowing funds from banks, Huang could significantly enhance his investment returns, contributing to his fund's rapid growth. This reliance on leverage, however, also introduced heightened risk to the firm's financial stability. Huang maintained accounts with several leading banks, including Goldman Sachs, Morgan Stanley, and Credit Suisse. These relationships were crucial in facilitating his trading activities and leverage arrangements because they provided the necessary financial services and credit that allowed Archegos to take on highly leveraged positions in the market. These banks extended billions of dollars in credit to Archegos, which Huang used to make large bets on stocks like Chinese tech giant Baidu and media conglomerate Viacom CBS. While derivatives and call options offer various benefits, they also pose significant risks, particularly when used excessively or without proper risk management. The leverage inherent in derivatives can amplify both gains and losses, magnifying the impact of market fluctuations on an investor's portfolio. Mismanagement or misunderstanding of these instruments can lead to substantial financial losses and even systemic risks in extreme cases, as seen during the 2008 financial crisis. While Huang's high-stakes investment strategy yielded impressive returns during periods of market upswings, it also exposed him to significant risks during downturns. The concentrated nature of his portfolio in just a few stocks and the extensive use of leverage meant that even a slight adverse movement in the market could result in substantial losses. And the culmination of these risks came to a head in March 2021 when Huang's investment firm faced a catastrophic collapse. Viacom CBS, one of Huang's largest holdings, made a disastrous stock offering to the market that led to a significant decline in its stock price. Analysts began to downgrade stocks in Viacom CBS, which led to a downward spiral in its stock price. The rapid decline in the value of Viacom CBS and other technology stocks held by Huang caused his prime brokers to demand additional collateral to cover the fund's exposure. When the stock prices dropped, the collateral backing the loans, the stocks themselves, decreased in value, which triggered a margin call. A margin call occurs when the value of an investor's margin account falls below the broker's required amount. To meet the margin requirements, Huang's brokers demanded that he deposit additional funds or securities into the account to maintain the necessary collateral level. This demand for collateral marked the beginning of the firm's rapid downfall, leading to one of the most significant implosions in the financial industry. For Huang, the magnitude of the margin calls was overwhelming, and he struggled to raise the necessary capital to satisfy his lenders' demands. As a result, he was forced to sell off his positions at distressed prices, further driving down the value of the stocks in question. This downward spiral intensified as the sell-off by Huang exacerbated the decline in share prices, creating a self-reinforcing cycle of losses. The resulting fire sale led to massive losses, estimated to be in the billions of dollars, and ultimately spelled the end of Huang and Archegos Capital. The Archegos meltdown reverberated across global financial markets, sending shockwaves throughout the industry. Huang's failure to meet margin calls resulted in a forced $20 billion fire sale of stocks by the banks aiming to recoup losses, which further depressed the stock prices and exacerbated the financial damage. Of Huang's key lenders, Goldman Sachs, UBS, and Deutsche Bank were first to recognize the seriousness of the situation and managed to liquidate their positions, minimizing their losses. However, others were not so quick to react. In the world of banking, it is every bank for themselves, and the early moves made by some of the banks only increased the losses for those slower to react, namely Credit Suisse and Nomura. Credit Suisse made a staggering $5.5 billion loss from the scandal, while the Japanese bank, Nomura, was not far behind, with losses amounting to $2.9 billion. Following his remarkable fall from grace, Bill Huang was arrested on April 27, 2022 on charges of racketeering, fraud, and market manipulation. These charges were related to allegations of defrauding investment banks and brokerages by manipulating the market prices of publicly traded securities and lying to obtain billions of dollars, which led to the multi-billion-dollar collapse of Archegos Capital Management. Following the collapse and his subsequent arrest, there has been no official information regarding his professional endeavors. The saga of Bill Huang and Archegos Capital Management stands as a modern-day Icarus tale in the world of finance, underscoring the perils of unchecked leverage and the critical importance of risk management. The story unfolds a cautionary narrative on the dangers of concentrated investments and over-reliance on complex financial instruments, demonstrating how swiftly fortunes can change in the financial markets. Through this tale, the financial industry is reminded of the delicate balance between pursuing high returns and managing the associated risks, highlighting the importance of diversification and robust oversight. So there you have it, the story of how one man, Bill Huang, managed to lose $20 billion in just 2 days. If you want to learn how to avoid Huang's fate and instead profit handsomely from the current challenging economic climate, click over to this next video where I show you just what to do. Thanks for watching, and until next time, keep building your wealthy life.